Welcome back to Around the Table with Stacy Smith as we take a look at the economy and investing. As I mentioned, the markets have had a solid November so far, but not all stocks are moving higher. So, Michael, if you happen to have some laggards in your portfolio, is now the time to sell them and perhaps take a look at taking a loss for tax purposes?
In general, Stacy, I think investors should be active when it comes to harvesting those losses. So when I joined Fregasso, almost a decade ago, I said that there were two things that I hate. I hate fees and I hate taxes. So when you're investing and you're hopefully doing well over time, it's inevitable that you will have some unrealized gains that build up in your portfolio. Right? For example, if you invested $1,000 in that Apple stock about 10 years ago or so, that investment may now be worth about $10,000, leaving you with an unrealized gain of $9,000. So when you go to sell that position at some point, you'll be required to pay Uncle Sam, $1,800 in capital gains tax. But let's just say you've been prudent at recognizing losses in your portfolios over the year. And maybe you did that during times of market volatility like we saw last year. So if you've ended up building up $9,000 in losses, those losses will fully offset the gains you made in Apple, and thus you won't have to pay the government anything. And there are a lot of different ways you can go about doing this and being tax efficient, Stacy. I think one of the most important things to realize is you do want to maintain market exposure when selling a particular security at a loss. Okay, what I mean by that is, let me give you an example. At Fregasso, we manage a stock portfolio for a number of our clients. And those clients own a basket of stocks that are designed to track and hopefully outperform the S&P 500 over a market cycle. But at any given time, some stocks may be worth less now than at the time we purchased them. So let's say we own Coke, and if Coke is trading at a loss in an account, we would sell that, recognize the loss, and then buy Pepsi, thus maintaining the sector and market exposure for the account. Then after 30 days, you could reverse that trade and buy Coke again. So all in, I think, is a very good way to be tax efficient in a taxable account. Obviously, you can't really do this for retirement accounts like IRAs, but overall, I think in a long-term approach, it's a very solid strategy for those who have taxable accounts.
I have to add something there. What Mike just said was not a recommendation to buy Coke or Pepsi.
Thank you, Frank. That is true.
All right. And these are the rules we must live with, and they're good rules because there are a number of people watching this show, and their objectives are not probably at all alike. So that being said, another thing that you need to consider from a tax harvesting point of view is because of the extreme moves we've had in the market this year, where it went up close to 20%, and it went down 10, and now it's almost back up to where it was. Actually, it's pretty much back up to where it was. The mutual fund companies have probably realized a lot of capital gains and are likely to make distributions because they have to. And those capital gains are going to show up like a big surprise in January when you get your 1099. So you can find out what they plan to do. And if you have other securities, whether it could be bonds that have gone down, or other stocks that have gone down, or other funds that have gone down because they were in the wrong market, it may make sense to harvest those losses to shelter the capital gains distributions those funds are going to probably give you this year.
Yeah, I would add to both, and to my previous point about, if Michael comes in here and, changes his mind, what is so great about Michael and what he does as a professional is the consistency. And that's really, the point really is if you're working with an advisor and all of a sudden they completely change their direction, then that's something that you need to be aware of. But back to this tax conversation, the harvesting of losses is really key right now because we have an opportunity to do some tax planning and really to strategize. And sometimes, we may be sitting on a tax loss, but if we know a client's going to have a big tax year next year, we may just sit here and wait until the calendar flips over to 2024 and take that loss in 2024. The other thing that you need to pay attention to when harvesting losses, if you're out of a company for 31 days, is to pay attention to their calendars. Do they have any shareholder meetings? Are there any earnings reports coming out? Something that may be specific to that company that could move that stock upward without, some other reasons. Frank's point about capital gains right now with mutual funds, it's huge. Because as we're adding money to portfolios, we're making sure that if a company is going to report a capital gain, that we wait until after that capital gain is actually distributed, because we don't want our client to get in and then get hit with a capital gain when they didn't have the benefit of that. Another angle of tax loss harvesting too is if we know a large capital gain is coming, we can look at holdings that we have and say, okay, well, this client has a gain, but the capital gain distribution is actually going to be larger. So let's sell the position now. We can always re-enter it later and flip it to some other security. If we're in an actively traded fund, we can go to an exchange traded fund. So it's a very important time of year for tax planning.
If I can ask this question, just so I make sure I understand it, when you're dealing with mutual funds, which by the way, we should devote a whole segment to at some point, but are you saying that if you happen to buy that mutual fund, let's say 2 days before they report their capital gains, that you're going to get hit with that capital gains, even though you've only had it for 2 days?
That's correct.
Well, to further refine, that's correct. 2 days may not be exactly correct. They have an ex-dividend date.
Yeah.
If you buy it on the ex-dividend date, which is before they distribute it, you will not receive that capital gains distribution. If you buy it the day before that ex-dividend date, you will get that whole thing and, of course, have received none of that benefit.
Wow. Okay. Very quickly, Ken, you have anything to add here before we take a break?
I do. Really quickly, 2 things. The thing that you've heard, we're an asset management company. We profoundly believe in doing all of these activities to try to, offset your gains. So I have nothing to add. These are all great strategies and we do them ourselves. But what you should be listening to is ask yourself, does my advisor do this? And they should. This is part of what they should do for you. I'm just going to say that as an advertisement to review who your advisor is, the advice you get, and make sure it includes taxes and tax strategies like this. The second thing, and I'll try to really hurry on this, like at the beginning of this year, would we ever believe we were sitting here with the market being where it is? I would say no. And we thought it was going to be a recession, never happened. We didn't know that GDP was going to hit 4% in third quarter. I think we all need to take the super smart people's forecasts with a grain of salt, because this is the time of year where people are going to tell you what is going to happen in the next year, and it rarely plays out.
Okay.
It just does.
And make sure that your advisor doesn't just do this in November and December of the calendar year. Do it. Make sure they're doing it all throughout the year when opportunities arise.
Okay, good. We have to take a break. We'll be back in just a moment.